The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair McLeod on behalf of Gold Money. And with me on the line from New York is Reggie Middleton, who runs Boom Bust Blog. According to Seeking Alpha, Reggie is the personification of the free-thinking maverick, the ultimate nonconformist as it applies to macro strategies, investment and analysis. If this is true, he's a man after my own heart. Welcome, Reggie.
How are you, sir?
I'm very well, very well. I first came across your work when I saw some very detailed analysis you did of on researching bank balance sheets and their liabilities and all the rest of it, particularly the US banks. And that must have been about, I suppose, 2 or 3 years ago. Now, you've obviously been following these banks very, very closely because you showed intimate knowledge. And so I'm really looking forward to getting your take on exactly how those banks are now faring, given that the immediate dangers seem to have receded into the background.
Well, the banks are pretty much the same condition that they were in when you first read the analysis. I have to take issue with the immediate threat being faded into the background, unless the immediate threat is defined as liquidity issues. The bank's liquidity issues were modified by the Federal Reserve and the U.S. government through a variety of mechanisms and machinations, such as interest-free loans, the modification of regulations that allowed the banks to basically ignore their problems and act as if they didn't exist. That created a facade of progress, of modification, and of the banks doing better. But from a fundamental perspective, they are still carrying the exact same assets that they had on their books when their problem initially popped up. The macro environment is getting worse, not better. And the banks don't have a way of creating true economic profit, simply because the economy is in the doldrums and people don't do things that usually generate profit for banks, such as takeout loans, active trading, buying and selling of securities, etc. So things look better. We've been told things are better, but all you have to do is just pick up the hood, take a look under the hood, and you'll see, the problem has not went away. In order to cure the problem, you have to allow the bad banks to go bust, and you have to let the bad assets be washed away. From the way I see it, there's no way out of that unless you have a true economic upturn. In order to have a true economic upturn, you need a reason for it. And I don't see one as of yet. I see a downturn coming, but not an upturn.
Well, that's interesting because really what you're saying, put another way, is that the zero interest rate policy actually is all it's doing is it's concealing the problems. It's not actually dealing with the problems. Have I got you right there?
Well, you have, and believe it or not, I don't think you're as hard on the ZIRP or zero interest rate policy as you should be. It conceals the problem as a solve. Think about when you get an injury initially, okay? You get a serious cut in your arm. You want to put ice on it, and the ice allows the blood to gel and stops the bleeding initially, okay? But over time, you want to apply warmth to it, which allows you to heal, increases metabolism. The zero interest rate policy is like ice immediately, but someone put the ice on and left it on, and now they're healed. The wound is actually freezing, and more damage is being caused. Zero interest rate policy causes banks to lose money over time for two primary reasons. Number one, banks make money by lending out money, right? If you lend out money at 0% or close to 0%, there's but so much spread you could get. Now, a lot of people say banks get money at 0% and then they do business with it and get a above 0% return, so they capture a free spread. Well, that's true in the short term, but in the longer term, when you give out capital for free, it's not respected. And when the capital is not respected, then it's very difficult to get a legitimate return for it because everybody now has free capital and awful decisions are made when you don't have a responsibility for the capital. And the responsibility will not be there if you never paid for it, which is the problem, the circular argument that goes with the zero interest rate policy.
Yeah, so effectively, I mean, we're actually solving nothing. We're destroying savings in a sense because, people who rely on savings, I mean, A, they get no return, and, and B, an awful lot of the population is sort of incapacitated in terms of spending because, their wealth is being taken away from them. And not only that, but savings are required to rebuild industry, and that is an important part of credit expansion when the business cycle gets going. So, I mean, it seems from what you're saying that this is actually, everything is sort of covered up, and it's the research that I was reading that you were producing 2 or 3 years ago, saying that there are big dangers in the system. These balance sheets are misrepresented, and so on and so forth. That situation is still true. So, if we can move on a little bit. More recently, I've noticed that you've been doing some very detailed research on the eurozone banks, and that I find interesting because you're applying the skills that you have got, if you like, in the financial sector in America on that. And is that seen worse, or how do you rank it in terms of nastiness?
Well, honestly, in my opinion, the banks in the larger, more developed areas of Asia, the U.S. and Europe are all in a very, very bad situation. So it's not as if which banks are good, which banks are bad. You have a very bad decision and you have a worse decision. You have to choose which is the best out of those two. And that's basically where we stand, where my opinion of where we stand with the U.S. and the eurozone. The U.S. has banks that are basically walking zombies, and these zombies have been reanimated with parlor tricks such as zero interest rate policy, regulation changes, etc. The eurozone have banks that are zombies that are not walking. They're actually lying down on the ground because they can't stand up, but they're being propped up, again, with the same tricks. The major difference is the eurozone, because of its construction, has the problem of too many chiefs and not enough Indians. You have 17 nations, all of differing economies, laws, financial structures, a variety of aspects that don't fit into a unified whole, but they're all trying to share one central bank and one currency. And it was something that was basically destined to fail from the beginning. The reason why this issue never came up is because we had a worldwide credit boom. So we had a worldwide bubble, and the bubble concealed a lot of the problems in the eurozone. Now that these problems are coming to the forefront, and the worldwide credit bubble has popped, the truth is coming to bear. The banks in the eurozone have gorged upon sovereign debt and used this sovereign debt that they gorged upon. They've levered up and purchased it at 10-to-1 ratios using borrowed money, and they kept this money on the balance sheets as risk-free assets. Now that is a misnomer. Okay, and we see now that many of the sovereign bonds are far from risk-free, such as the Greek bonds, which have been defaulted on, and a lot of entities have gotten between 17 cents and 40 cents on a dollar. Imagine if you levered up on Greek bonds, you bought $1 billion worth of it with, say, $100 million worth of equity, and you take a 60% loss. You're deeply in the negative, you're insolvent. And that's the case with much of the eurozone. On top of that, you have a weakening economy, and you have banks that are simply zombie status. You have a lot of them that are zombie status, very tightly related and correlated.
Yes, indeed, and of course the sort of the get out of jail free card is this anticipated economic recovery, which is a myth. Really, that's not going to happen either, is it? It'll happen eventually, but it's not going to happen anytime soon. The primary inhibiting factor for the economic recovery is the fact that the oligarchy in Europe, those that are in power, don't want to relinquish the position. And that has to be done. Just like in the U.S., the best way to get economic recovery is to recognize the bad assets as bad assets. Let the market price them
from a fundamental perspective. If it's only worth 15 cents, then 15 cents should be what it's called. But in order to do that, you have to force certain institutions into insolvency. Okay,
yes.
As insolvency. The Europeans do not want to do that, because if they do that, there's going to be a significant shifting of the guard. And of course, to be a shifting of the guard, you either need the cooperation of those who are falling from the top, or they have to be forcibly removed. And it looks as if forcibly removed is the only way to go, because nobody's going voluntarily.
Yeah, but I think it's worse than that, Reggie, because we've had a few changes of the guard. I mean, we've had, two governments in Greece since the crisis broke there. We've had the replacement of Berlusconi with an unelected bureaucrat. We've had an election in France where the man who was trying to cooperate, Sarkozy, has been kicked out in favor of a socialist who wants to tax the rich, reduce pension ages, reflate the economy. You've had a government replaced in Spain, which sadly has not been able to progress things any further than the previous government. I mean, we get these changes, and yet the changes do not seem to resolve anything. They still carry on in, if I can use your phrase, their sort of zombie-like state, sort of propped up by something, God knows what.
Well,
and then
the reason, I'm sorry not to interrupt you, the reason why these perceived changes have not had any real effect is because they're not true changes. You had a change in the government, okay? But if you take a look at the entities that were in power, who funded the government with loans that could not be repaid?
The banks.
Okay. How many banking officials have faced criminal charges?
0.
Exactly. And as long as that number remains at 0, you're not going to have effective change. Either criminal charges or the banks, from an economic perspective, have to be wiped out. When the banks are wiped out, the bad assets will be forcibly marked to market. And then you have new entities with new capital and new ideas come into play, and you get to start over and reset. But all the large banks that did the funding are still there. As a matter of fact, the new governments are ex-employees of the banks that wrecked the old governments.
Yes.
So we have not budged an inch as of yet.
No, that's very, very true. But if these banks are going to face reality, there is a contagion risk, and the contagion risk, basically, it seems to me, is going to wipe out an awful lot of banks, if not virtually the whole of the European banking system. Is there a middle way, or do we just have to recognize that fact?
I don't think we should search for a middle way. If the contagion banks will get wiped out, that means that there are too many banks. Okay, or banks that are there are inefficient. If you believe in true market theory, okay, survival of the fittest, true capitalism, when you have an inefficient entity, an inefficient business, right, that cannot cover its cost of capital, it should fail. But
Indeed.
you have entities that cannot cover their cost of capital in normal operation without basically wrecking clients, and they're still in business, which is why it's a significant drag on the economy. Right, to lift the drag off the economy, you have to have entities that fundamentally surpass the cost of capital in doing business.
But if I can come back to this contagion thing, I see a situation here where the eurozone banks, and the interesting one is France, which is in the middle of this. Nobody talks about France, and yet I sort of think that the French banks have exposure right at the heart of the eurozone. And if you get a banking crisis, or if someone actually faces up to reality, the French banks are going to get it very, very severely in the neck. And some of these French banks have got quite large derivative positions. And so that brings in the broader question. If you have a banking crisis in the Eurozone, then it's going to spread into the derivatives markets, isn't it?
Most likely any crisis is going to affect the derivatives market, because the derivatives market is now so large. Okay, but a lot of people vilify derivatives, and derivatives, I believe, are a necessary tool in modern finance. The problem with the derivatives markets are not derivatives per se, but the fact that the banks were allowed to buy, sell, trade, and hold derivatives whose actual value are fantasy and made up. You have a product. You buy a building, and that building is devalued by 60%. Okay, you cannot go and get a loan on that building as if it was 100% in value because it's devalued. Okay, with derivatives, a lot of derivatives that a lot of the banks are trading and holding as assets, investment grade assets, have opaque valuations. Okay, or no valuation, right? And they actually sell these products to state entities such as a lot of the sovereign nations. And then the sovereign nations have politicians, not statisticians or financiers, who have absolutely no idea how to value these. They purchase them, and then when they blow up, then you have the problems that you have now, such as the problems in Greece or in Portugal, etc. If you had true market pricing of products, you would not have a problem with derivatives. The US dollar was once a derivative by deriving its value from a unit of gold. The US dollar actually did very, very well. So again, there's nothing wrong with derivatives. Now, if the US dollar could not be valued because, nobody's ever told what unit of fixed asset, of real asset that the dollar was backed by, then you have some issues. But you didn't have the issues because it was clearly said it was backed by gold. No longer being backed by gold as a fiat currency, it's now backed by the full faith and power of the U.S. government. Now, that may be ambiguous, but everybody still knows what the U.S. is and that the U.S. has power. The derivatives on many of the banks' balance sheets and a lot of the sovereign balance sheets have absolutely no pricing clarity whatsoever.
I think that's a very interesting comment, and I would agree with it entirely. I mean, it seems to me that there is a certain tension between the pricing of derivatives, which seems to be computer-driven, and the fact that prices in markets are actually human-driven. And if you have a real build-up in the value of derivatives, because markets are basically priced on the back of human action, human thoughts, and it's effectively prices which are subjective, which don't have any relationship, then you are building, I think theoretically, you're building a potential crisis on the back of the growth of these derivatives. But I think that's, in a sense, it's probably we're getting off topic a little bit. But one of the things I think I've noticed, and I'd be interested if you could confirm this or not, that derivatives are accounted for differently between the US banks and European banks. As I understand it, the US banks will carry a net position on their balance sheets, whereas the eurozone banks carry the gross positions on each side, making their balance sheets look considerably worse or more highly geared, if you like, than the US banks. Have I got that right or wrong?
I think it really depends on the actual bank itself, but the European banks do look significantly more levered. But there's, no matter which way you look at it, neither of them are actually, in my opinion, an accurate way of looking at the risk of the balance sheet. Let's take the U.S. Okay, you have a net position of derivatives. So you have, let's use something very simple, like over-the-counter puts and calls, where a put is a contract that benefits when the asset goes down. A call benefits when the asset value price goes up. So you have $1 billion worth of calls and $800 billion worth of, $800 million worth of puts. Okay, so you have a net position of $200 million long, whatever assets underlying the options.
Yeah.
Okay, but these are over-the-counter options. So in order for, or let's assume, let's make it even simpler, you have $1 billion on each side. So you have a zero net balance. So this bank, US bank, says we have a zero net position in derivatives. Okay. Yep. That only works if the guys who sold you the puts and the guys that sold you the calls actually honor their agreement. Okay, but let's suppose the market goes down, right? And you assume you're hedged because you have all your puts and all your calls. You have to honor your calls. You do honor your calls. But the entity that sold you the puts hedged those puts with another bank in Europe. Europe goes bust. He cannot honor his puts. So now you only have $1 billion of net long exposure. So if the market does go down and your counterparty fails, well, then you went from zero net exposure to $1 billion net exposure long in a falling market. Okay,
very, very dramatic. I mean, so it's really counterparty risk is just not being considered in this.
Absolutely not. Netting works very well until you need it. Just like liquidity. Liquidity is always there until you need it. The market is extremely liquid until you have a disjunct or until markets start to collapse, and then the liquidity dries up immediately. So that's why it's very, very foolish and unrealistic to rely on liquidity as a given in a market that can have drying up of liquidity. And that's a problem with netting out. If you're going to net, you have to have hard collateral. Okay, the collateral has to be extant in the account already, and you have to account for fluctuations, valuations, and value of the collateral itself.
Yeah, absolutely. This is at least as bad as I thought. Reggie, you're a trader, really, aren't you? And I wonder, how do you protect yourself in these very, very dangerous times?
Well, actually, I'm not a trader. I'm a strategic investor.
Sorry, strategic investor. Correct.
The difference is I'm not very good at trying to figure out what happens tomorrow or next week. I look at patterns, trends. I try and find truths that are uncovered, and then I go anywhere from 3 months to 2 years out. So that's what I'm best in. I'm just not a good trader.
Yeah.
The advantage of that is I get to look past quarterly fluctuations. What happens, if Bernanke had a bad day and his wife argued with him and he said something untoward, etc.
Yes.
The bad part of that is you have to put up with short-term fluctuations, right? Even if you are correct, in order to realize your long-term goals, even if your long-term goals are in unison with actual reality. Now, as for how I protect myself, I simply look at risks and I make sure that the reward that I attain is worth the risk that I take. There's a formula. I have children, and I teach my children that the definition of risk is deviation from your expected return. Okay, so risk can be something on the positive side and negative side, but risk is basically a surprise. And risk itself is the price that you pay for expected return. So if I want $1 worth of reward or return, I have to make sure that I pay 90 cents or less in risk for that particular dollar.
Yeah.
Okay. So that's a theoretical 10% profit. Theoretical 10-cent profit. Now, with that in mind, if I keep that mindset, every opportunity that I go after, every deal that I do is guided by that metric, of paying less in terms of risk for the reward that I'm going after. That guides me to a variety of opportunities, such as deciding who has the least amount of risk: China, Japan, various countries in the EU or the EU itself, other parts of continental Europe, the UK or the US, and companies in each area that I described. I simply look at the risk situation, and no matter how risky it is, it's still relative to everything else. Then I try and calculate the reward. That makes nations such as the US, which I've been very bearish on, look relatively good to certain areas in the UK. I'm sorry, not UK, in the EU, simply because the EU situation is a bit more untenable, primarily because you only have one entity that could truly print their own currency in the EU, and that's Germany. It prints the euro. Germany is pretty much calling the shots there.
Yeah.
But, Germany, for some reason, is perceived as the panacea to all the EU's problems, which is absolute nonsense. Germany is a net export nation, and they export to the US, Asia, China, and the EU in reverse order in terms of priority, right? The EU ranges from recession to outright depression for Greece. China is ranging from a hard landing, best case scenario, to a recession. And the US is in a never left recession, in my opinion.
Yeah.
So, we have a net export nation whose exporting partners are all ranging from hard landing to depression. Exactly how are they going to pull the EU out of the hole? They live in the same motel as everybody else. They just have the penthouse suite.
Yeah, indeed. That's an interesting one. I was, I've been talking to various people about Germany, and the feeling I get is very much that the Germans and the Finns and the Dutch and so on are really trying to find a way of backing out of this problem because it's bigger than they are, really. I was talking to one economist who is German by birth but lives in Madrid, so he sees both ends of this eurozone problem. And he's calculated that the cost to the German taxpayer is 4 times tax revenue. And given that their taxes are higher than 25% of GDP, I mean, we're talking about a tax imposition greater than the sum total of what everyone in Germany earns. I can't really see how this situation can continue. It's just extraordinary. And trying to find investments in that environment must be well nigh impossible. And we see some companies beginning to withdraw funds from the eurozone because they're getting worried. That's something which presumably you have also noticed.
Yes. There's the old precept, first be worried about return of your capital before you concern yourself with return on your capital. And that should be what the German government is concerned with. I believe that it's impossible for the Germans to fund serial bailouts. And even if it was possible, it's not prudent. So what they have to do is they have to weigh the cost, the opportunity cost and the actual cost of either pulling out of the euro or forcing the more profligate states out of the euro themselves. But in doing that, you're going to have an unprecedented event and you're going to have significant contagion. Okay. So it's between a rock and a hard place. I preferably would prefer the hard place than the rock, but it's a very difficult call.
Yeah, it is, isn't it? It's virtually impossible. You touched on the subject of gold. Really, I think you described the dollar originally as being an option, if you like, or rather like an option on gold. What's your view on gold nowadays? Do you see this, sort of reflecting perhaps all the anxieties, all these problems which you've so clearly identified? Do you think that it's just been left behind, or how do you see it?
Well, gold was an interesting fundamental macro trade, particularly a year and a half ago, before it shot up. I am not a precious metals expert by far, so that's my disclaimer. My concern with gold, as with everything else, is once it becomes very popularized in the media, once it becomes digitalized, like the GLD and the various ETFs, then there's significant risk. You can be on the right side of the trade fundamentally, right, and still get capsized simply because of the popularity of the trade. It has attained cult status, or you have disjoint in between the actual value of the asset and things that go on in trading. I'm very concerned with entities such as the ETFs, such as GLD, that take a significant amount of money, and apparently more money than they may have access to in physical assets to back it. And I see that to be a problem. If you could take all of these issues off the table, as long as you have the bumbling of the leaders of the countries, you have a strong fundamental reason to have an interest in gold or any asset that is not as easily manipulable. But it appears through financial engineering, people have found a way to manipulate everything, with the gold being included.
Yes, I mean, I think that's right. There's bound to be a vested interest, particularly with interest rates so low, to try and de-emphasize the alternatives, if you like, which people might look at as a means of hedging against systemic risk, or however they see it. So I think from what you're saying, you would probably support the sort of thing that we do, which is to offer a facility for people to hold physical gold completely outside the financial and banking system, and just as a little bit of insurance policy, if you like. Would you agree with that statement, or? I more than agree with it. This is the way I look at it. If you have a digital version of the asset, okay, then you have not removed yourself. You have not hedged yourself against the problem.
because you are now part of the problem. If you feel you own the asset, but the asset is within the banking system, you're concerned of a collapse of the banking system, then your concerns are, of course, well-founded, but you've done nothing, right, to shield yourself against it. If you're going to shield, if your concern is a collapse due to derivative pricing meltdown or the collapse of the banking system, you should have nothing to do with derivatives and should not be within the banking system in any way whatsoever.
Yep, no, that makes sense. Now, Reggie, you have your blog, the Boom Bust blog, and so on. How can our listeners find you?
You can simply go to boombustblog.com, where you have daily updates. You can also reach me via Twitter, where I tweet my opinions on a free basis, daily, sometime hourly, every other day. And you can also email me through the blog. I have a significant amount of research, the vast majority of which is behind a paywall, but I give a copious amount of free opinion. And I also give research on occasion, about once a month, every month and a half. I distribute that for free. I believe that my research is extremely thorough and accurate. Of course, I'm slightly biased, but I all come see themselves.
I think, actually, I think you're doing yourself an injustice. I've found your research to be extremely detailed and thorough. And if you can tick those two boxes, there's not a lot of room for bias. Reggie, I'm very, very grateful for giving us some of your valuable time. And, perhaps at a later date, we might come back to you. So on behalf of all our listeners, thank you very much indeed.
You're very welcome. Glad we come back.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.